Delaware Statutory Trust, it's a trust, it's an entity. They were created in the 80s. They weren't set up for 1031 exchange purposes at that time, but it's a trust whereby you have one trustee that manages the trust on behalf of 499 beneficial owners. So when you take this trust and you wrap it around real estate, it creates a situation where you fractionalize ownership interest in one or many properties. And in 2004, the IRS came out and validated this fractionalized structure as real property ownership and therefore eligible for 1031 exchange purposes.
Talk to me about 1031s. I told you I was going to give you this question. Explain to me what a 1031 is exchange as if I'm a fifth grader.
IRS Code 1031 is the most powerful, I would say, the most powerful tax mitigation structure or vehicle in the tax code. It's been around for 100 years, over 100 years. And essentially what it allows for is investment property owners to sell their investment properties, and defer paying taxes on any of the gains as long as they exchange the proceeds from sale to buy other investment property. If you own real estate that's for investment or business purposes, it's 1031 exchange eligible, and you can exchange the proceeds again from sale into other like kind, which essentially like kind is a very loose definition. It's just other property that's used for business or investment purposes. So you could sell land and go into an apartment. You can sell an apartment and go into a hotel. It's just like kind.
I love 1031s. You know, when I put my broker hat on, 1031s feed my family. So
100%, right? It's the way so much wealth in the country has been built, and why the 1031 exchange is so attractive, because, you know, a term that I'll throw around is you swap until you drop. You can continue to swap or exchange, right? Exchange, swap, never pay tax, and then pass away, and your beneficiaries, your kids, whoever, can inherit those assets at a stepped up cost basis. So all the taxes you've deferred over the 20, 30, 40, 50, 60 years, they're gone. Mm-hmm. That is why the 1031 exchange is so powerful.
I'm going to say that to my dad, swap till you drop. Keep on thinking as funny as I think it is, but that's I've never heard it referred to that way. So that's funny. Now, you and I briefly spoke. Delaware Statutory Trusts. What is a Delaware Statutory Trust, and what is it in relation to a 1031 exchange?
Yeah, it's perfect for your the title of your podcast, right? Secrets. Yeah. I will define the DST, and then I'll take a step back and kind of tell a little story. But Delaware Statutory Trust, it's a trust, it's an entity. They were created in the 80s. They weren't set up for 1031 exchange purposes at that time, but it's a trust whereby you have one trustee that manages the trust on behalf of 499 beneficial owners. Right? So when you take this trust and you wrap it around real estate, it creates a situation where you fractionalize ownership, right? You can have lots of investors fractionalize ownership interest in one or many properties. And in 2004, the IRS came out and validated this fractionalized structure as real property ownership and therefore eligible for 1031 exchange purposes. So that's just the structure. So what are we talking about here? And what do they do? In my world, DSTs, there are sponsors, and a sponsor is a big real estate company, right? I'm going to throw out some big names just so the audience may. Sponsors in my space are Apollo or Ares or Jones Lang LaSalle or Cantor Fitzgerald or Inland or Pasco. There's 50 different sponsors, big real estate companies. They go out and use their resources, their capital, their relationships to acquire institutional quality real estate. That may be in the form of a $100 million industrial property in Raleigh, North Carolina, a $100 million multifamily, 400 unit multifamily property in Dallas, Texas. $75 million medical office campus in Orlando, Florida. So you have all these sponsors, they're buying, institutional quality real estate. They're bringing on the third-party property managers, right? They're the ones that are going to be issuing quarterly performance reports. They're the ones that are going to be providing monthly distribution checks to investors, end of year tax returns. So they buy this real estate, they wrap it in this trust, and they turn around and they offer ownership interest to mom and pop, you and me, everyday 1031 exchange investors, that if you sell your property, you can exchange into one or many, right?
Wow.
And going back to and these properties are, they're stabilized, they're income producing. Some of them are leveraged, some are not leveraged. Totally turnkey 1031 exchange replacement property solution. And given the fact that, going back to the structure, you're allowed up to 499 beneficial investors, the minimums are low, right? So an investor can come in, invest as little as $100,000 in most of them. And so, I give the example, little Mrs. Smith that comes to me that's selling a property in Orange County or LA or San Diego with $1 million or $2 million or $5 million. I can satisfy her exchange, obviously, through investing. I can mitigate her risk through diversification, because I could put 250 here, 500 here, $1 million there, 250 here, 100 here, right? So you can mitigate risk via diversification by sector, real estate type, and also location. And then, more times than not, we're able to improve the income that our investors are receiving.
Can you elaborate on that?
The income?
Yeah.
Yeah, absolutely. So I'll tell you, 8 out of 10, maybe even 9 out of 10 of our investors, they've owned real estate. They've worked their whole lives to acquire one by one and accumulate this real estate portfolio that they've managed themselves. And they were killing it when they bought it. So they bought a property for $500,000 and they were getting a 10% income stream at the time. Awesome, right? Well, fast forward 20, 30, 40 years, they haven't been ratcheting up rents. And so many of them are still only charging the same 10% that they were charging back then. And so from a percentage basis, most of our clients are earning 1% to 3% income relative to the equity or the property value today, right? And so in our offerings, I'll give you a range. I mean, it depends on the sector and the location, all that stuff, but anywhere from like 5 to 8% is kind of like the range of where income is today on these projects. And so many times we're able to significantly increase a client's income. These same folks that are earning much income relative to pricing, they've also fully depreciated their properties, right? So all the investors that have owned them for 20, 30, 40 years, you have no more cost basis. And so all the little income that you're earning or they're earning is being fully taxed at ordinary income rates. And we can not only increase the income, but we can add back depreciation so we can increase the tax efficiency on the income that they receive as well.
I have 15 more questions. Okay.
I know.
In a 1031, traditionally 45 days to identify, 180 to close. Talk to me about the identification process in a DST.
Yeah, great question. It's very simple, right? And I'll just say that these properties, as I mentioned, they're already acquired and owned and stabilized. These big sponsors, these big institutions own the real estate already. So in a 1031 exchange, as you know, but for the audience, the IRS has blessed us with this ability to defer taxes, but they don't make it easy, right? So you have 45 days to identify, and that's not easy. You got to go out. If you're going to do a traditional exchange, you go out and you're going to have to source your own property and do your own underwriting and get your own loan if you need a loan. It's not easy to do in 45 days. These, very easy. You can identify something today and close in a week, right? So I don't necessarily like this, but investors come to us on day 44 or 45 and say, in a panic, these properties fell out. I don't know what to do. Can you help me? Yes, we can. We can identify quick, very fast, right? So at the very least for your audience, you can use this product as a backup plan, which is what I'd recommend at the very least. That makes sense.
Yeah, absolutely. Do these companies, say they own that $100 million warehouse and you buy into it, do they have exit deposition plans or how does that work?
Yeah.
Because, you're hopping on a train and you're not the conductor of the train.
Yes.
How does that work?
Yes, that's great. I love it. Great question. So absolutely they do. And that is my job. That's where I get involved. I spent 15 years on the syndication side. So I was with these sponsors, buying the real estate, doing the underwriting, the due diligence, all that sort of stuff. And so I'm intimately familiar with this space. And so that's my job in helping clients. And that's really the value that I add or that we add as a company. There needs to be, aside from a good real estate and the fees and the management teams, which are also very important, there needs to be a viable path for an exit, right? For appreciation. Quick example. DST could have one property or multiple properties, but let's say there's a DST out there that has 3 multifamily projects in there. There's 2 in Florida and 1 in Iowa. I may love that portfolio. I may love the Iowa asset. I may love the Florida. I may love the whole thing. But I'm looking at exit, to your point. Is there a likely buyer that's going to pay a premium for 3 assets, 2 in Florida, 1 in Iowa? Maybe not, right? They may say, I want the Florida ones, but I don't want that Iowa, right? And that's a very simple example, but that's what I'm looking at. I'm also looking at, again, the fees on the front end. Is there a viable path? How are they going to create value? Right? Is this an asset that's going to be sold to a publicly traded REIT or a private equity group? So that's my job, frankly. But yes, it's very important.
That makes sense. You essentially are the intermediary between a buyer and the trust that they'll, the syndication that they will parlay into.
Right. And there's a lot of bad actors in my space. I imagine lots, other industries as well. So you have to be cautious. What I just said for the listeners sounds amazing, but you have to be working with the right people. And I'm not just saying that to toot my own horn, but that's the biggest risk I'd say in my space.
Hey, any step of the real estate process, a property manager, leasing agent, title.
Right.
You have to be dealing with capable, ethical people, or else you
never know. You never know. Right. I have 20 years of experience to lean on. Right. I've had some bad experiences, which I've learned from. Right. With folks that I've trusted, but you live and you learn. And Aviva, I just have to say this because I missed I didn't even say the biggest part of this whole thing. I talked about turnkey, right? Income. These opportunities are 100% passive, right? So the ideal or prototypical investor, and I touched on this, are the baby boomers, the seniors, right? Those folks that have worked all their life, they've accumulated all this real estate, and they do not want to take one more single call from a tenant about anything, right? They don't want to replace the toilet, the 3 T's, trash, termites, tenants, toilets, whatever they are. They're over it. They're over it. They are hoping and dreaming and praying of a solution that will allow them to sell their real estate, defer paying taxes, and redeploy that in other structures that provide stable, predictable income. Right? That they can spend more time with their family and do everything else they want to do right now. And so I can't believe that. Forgive me, audience. I totally forgot to say that on the front end.
I believe on the street we call that a coupon clipper.
Yeah, some are coupon clippers. Some are more opportunistic than others. But by and large, yes, the coupon clipper holds true.
Are you seeing a product type perform better in DSTs right now than others?
Absolutely, right? Everything's cyclical. Industrial, the world you live in, has been hot for quite some time. I think it will continue to be in high demand, which, especially with the administration and their initiatives, like them or hate them, their initiatives, I think it's gonna fuel industrial, which is a good thing. And for the baby boomers out there and the seniors that are holding on to their asset and have built their businesses and they're, now or could be a great time to sell, frankly. You'll get premium. But yeah, I mean, everything from like, I'm not encouraging our clients to invest in retail right now. Now, hopefully, retail has done, it's done okay, but there's still a lot of uncertainty, if you will, with what's going on today. And so our clients have already made their money. They're not necessarily looking for, crazy returns. They're looking for, as you said, coupon clippers. So retail is not typically a food group that we would recommend. My whole thing is, in the spirit of my clients, they're already rich. They're trying to get rich. They're trying to stay rich. And so what are those defensive, resilient sectors that are going to perform in good or bad times, right? Necessity-based sectors, multifamily, healthcare, storage to some extent. I guess an outlier I would say that I love today is mineral rights, oil and gas mineral rights. Love it. Love it. Investing in energy. It's another way to diversify your portfolio.
Okay, so you can go from selling a warehouse into minerals.
Yep. Love them. Such a great sector. So widely unknown.
Ay, Ben, I could.
You got 100 questions. You know.
I know.
No, it's good.
No, it's fascinating. It's fascinating.
Yeah.
Yes.
It's so. Let me just, because I'm going to talk about the downsides, right? I didn't even touch on that. I've been talking high. The downsides of a traditional DST. For some, it doesn't matter, but nonetheless. The syndication, if you invest in a DST, you're going to be in there for, call it 5 to 7 years, right? There is no secondary market. You can't just sell your position, right? So if you get into a DST, you're going to be committed. You have to at least expect you're going to be committed for 5 to 7 years. Could they sell sooner? Yes. Later? Yes, but usually it's 7 kind of is the high. So that's a big thing, right? Somebody has to be willing to give up control and put their full faith and trust in a sponsor company that they may be big, but it's not them. And these folks, our clients, have managed the real estate for so long, like, I'm not trusting anybody, right? That's the biggest downside to, I guess, the DST. Now, for our bigger clients, if you're a client that has 3 million, 5 million, 10 million or up, we can customize these deals, because the client will tell me, Beth, you're going to have to kill me before I give up control to somebody I do not know. Not going to happen. Period. I understand. But we can work with the sponsors, right, that I've known for 20 years now. I used to work with them. We can customize a deal for that client, and it operates the same way as a DST in the fact that it's completely passive. You're going to get your monthly income. You're going to get your quarterly reports. You're going to get your end-of-year tax statements. But if you want to refinance or if you want to sell, you can do so. Like it's your property, but we have the infrastructure in place to relieve you of any responsibilities that you don't want.
If you bought a DST that had a car wash in it, would you capture that bonus depreciation?
Yes. Thank you for asking. I love it. So some of the, yes. With convenience, car wash, there are sectors, as you know, that benefit from the bonus depreciation. Absolutely. So a DST or the custom deal that I just mentioned, you get it's the same exact thing of all the benefits you get from direct ownership, you get with the DST or the custom deal. So bonus depreciation is huge, right? Wow. Yeah.
So wouldn't it be advantageous to say for a DST to buy 10 warehouses and 1 car wash just to capture that depreciation?
So I'm about to open up another 50 questions, which I know we won't have time for. But okay, so the DST itself is there are, just like all entities or trusts or REITs or whatever the entity is, there are guidelines or restrictions to safeguarding or protecting the sanctity of the entity itself. So like for a REIT, you have to distribute 90% of your income and invest 75% of whatever you raise into real estate related projects. If you don't do so, you lose the REIT status, right? Same with the DST.
Wow. Yeah.
But Delaware Statutory Trust, it offers all these great things, but there are limitations or restrictions. And I'll just name a couple. In DSTs, there's no capital calls per se, right? So if you, Aviva, own your own property and there's an issue at the property, you're going to come out of pocket and you're going to pay for that. In a DST, you can't ask for more money, right? So the only reason I bring that back to the car washes, those are more, they're seasonal, cyclical, in terms, when a rainy season, car washes aren't going to be doing as well, right? Maybe you need to do renovations because of X, Y, Z. So yes, car washes can be in a DST, and they could be in what you described, this industrial portfolio with one car wash. They could do that. But I just bring up these examples because there are some limitations that would prevent creating some of the investment.
Fascinating. That is cool. Okay, it's niche cool, like cool for us. I don't know the commercially cool, but no, I'm just kidding. It is commercially cool. We're working on it.
Yeah.
For the listeners who may not know, what is an accredited investor?
Right. So accredited investor is an investor that has a net worth of at least $1 million, excluding their personal residence.
Got it. And so for securities purposes, I know I'm already getting into the weeds, but I think this is really important to know. For securities purposes, why do we need to know if you're accredited in order for you to invest in a syndication?
Well, it's very important because you can't invest if you're not accredited. Well, in the opportunities that we are involved in, right? There are other securities and syndications that are eligible for those that aren't accredited, but for purposes of the investments that we provide, you have to be accredited.
Understood. Ben, what's a commercial real estate secret for the listeners?
I don't really have anything. I would say hard work.
That's a good one.
That's it.
That is a secret.
Hard work. Harder you work, the luckier you get.
Amen. Ben, this has been really, really fun and interesting and high value for me and the listeners. Thank you so much for being on the show today.
Absolutely.
To learn more, go over to perchwealth.com. And for everybody listening, we'll see you next week.